All right, let's get right into it. Welcome to today's Explainer, where we're taking a Wall Street grade, data-driven look at Sainsbury PLC, ticker symbol SBRY. But listen, we aren't just going to skim through some standard metrics here. We're going to ruthlessly triangulate the stock's intrinsic value by running its latest financial filings through the legendary frameworks of four absolute investing titans: Warren Buffett, Benjamin Graham, Philip Fisher, and Peter Lynch. We're going to find out exactly how this historic British grocer holds up under the strictest criteria in the value and growth investing playbooks.
To set the stage, we're talking about a true retail giant here. Over £33.6 billion in underlying group sales for 2026. It is a staggering top-line figure. But as any seasoned analyst knows, massive revenue doesn't automatically equal massive shareholder value. It really begs the question, is this sheer scale actually creating real, durable value for investors? Or is this just a massive operation spinning its wheels?
To answer that, here is our roadmap. We're going to cross-check this stock through the lenses of Buffett, Graham, Fisher, and Lynch before pulling it all together for our final valuation cross-checks.
First up, Warren Buffett's strict test for moat and quality.
Clinically speaking, because of the harsh reality of grocery retail economics, Sainsbury's actually fails some of Buffett's strictest quantitative checks. I mean, Buffett loves a return on capital employed of 15% or higher, right? Well, Sainsbury's comes in short at 8.9% for 2026. And on leverage, a conservative net debt to EBITDA ratio is usually under 2.0x, but they're sitting slightly elevated at 2.6x. However, it's not all bad news. They absolutely pass on operational efficiency, managing to maintain a highly competitive 6.59% retail EBITDA margin despite some intense industry inflation.
But remember, Buffett isn't just staring at spreadsheets. He demands a business you can explain in a single sentence run by a highly focused management team. And CEO Simon Roberts nails this test for business simplicity. By explicitly stating they are putting food first, management is totally rejecting distracting vanity projects and focusing all of that massive scale on their core competency, efficiently feeding the UK.
Moving right along to our second lens, Ben Graham's legendary test for a margin of safety.
Now, remember that 2.6x leverage ratio that kind of spooked us a minute ago? Well, if you really understand grocery balance sheets, the data tells a completely different story. While that top-line debt looks heavy at £5.74 billion, anchoring on the exact data reveals that a massive $5.44 billion of that net debt consists purely of lease liabilities for their physical stores. Strip that out, and their actual non-lease net debt is a highly manageable $203 million. Suddenly, this balance sheet looks incredibly defensive, which is exactly what a Graham investor is hunting for. Plus, they easily check the box for Graham's earnings stability rule. A true defensive stock has to have a proven track record of resilient net income. And here, we're seeing a statutory profit jump from $253 million to £393 million over the last year. Despite extreme macroeconomic headwinds and fierce competition from the discounters, Sainsbury's remains a highly profitable machine. Okay, let's pivot to Philip Fisher's framework, searching for qualitative growth. I know what you're thinking. A 157-year-old grocer doesn't exactly scream Fisher growth stock, but Nectar360 is literally Fisher's qualitative dream. It is not just some simple grocery stamp card. It's a highly sophisticated personalization engine, monetizing the habits of 18 million shoppers. They're processing immense amounts of first-party data to generate over 260 million unique offers every single week. This is organically transformed into a fully fledged retail media business with over 870 direct brand clients. And why does this matter so much for our valuation? Because this loyalty data isn't just retaining customers to protect the grocery moat. It's a dedicated profit center. Management is forecasting a cool £100 million in profit strictly from Nectar360 by 2027. They've essentially built a high-margin advertising network right on top of their low-margin retail footprint. Fisher would be fascinated by this kind of hidden internal growth engine. Fisher was also a huge stickler for supply chain integrity and management depth. To ensure supply resilience, Sainsbury uses this really unique cost of production model with its 240 dairy farmers. They actively review input costs like feed and fertilizer every 3 months to ensure those farmers are paid fairly. It's brilliant because it protects the supply chain while keeping shelf prices competitive. That is the exact kind of hidden operational excellence Fisher prize. Next up, Peter Lynch and his growth at a reasonable price, or GARP, methodology. Before we can judge value here, we have to classify the stock exactly the way Lynch would.
With underlying sales growth of just 2.7% and underlying EPS growth of 3.2% over the last year, Sainsbury's is practically the dictionary definition of a stalwart or a slow grower. Lynch's rule here is simple. You own this for the robust free cash flow and the dividend, not for some crazy top-line explosion. You're basically looking for a reliable 10 to 12% total annual return through a mix of modest growth and heavy capital returns.
Because it's a stalwart, Lynch wants to see prudent balance sheet strength and massive internal cash funding. He doesn't want them diluting shareholders just to survive. While management demonstrates phenomenal capital allocation here, they're heavily investing in their workforce, giving a 40% pay increase for colleagues since 2021 to ensure great labor relations, while simultaneously returning over £800 million directly to shareholders. That includes a £251 million share buyback that directly accretes earnings per share.
Finally, let's bring it all together into our valuation cross-checks to find that intrinsic value. Let's run the hard math from their 2026 actuals. By anchoring on the 333.90 pence share price and the 22.3 pence underlying basic earnings per share, we get a trailing PE ratio of roughly 14.97x. But you have to remember, that PE is backed by a massive £574 million in retail free cash flow. Also, look at this dividend structure. You're getting a 13.7 pence total ordinary dividend, plus a massive 11.0 pence special dividend following the strategic review of their financial services. For the die-hard defensive value investors out there who want to see depressed multiples for a mature business, we have to ask the ultimate question. Does that price tag clear the rigorous hurdles required for a true margin of safety? Does it actually pass the Graham multiplier test? The short answer, yes. Coming in just a hair under Ben Graham's strict 15 times earnings threshold at 1497x, the math absolutely confirms we are looking at a reasonably priced asset. You aren't overpaying for some speculative future growth here. You're paying a fair price for current, proven, rock-solid cash flows.
Which brings us to our final verdict for this explainer. Look, Sainsbury's isn't going to give you the rapid 15 to 20% growth required to be one of Fisher or Lynch's fast growers. But its massive £574 million free cash flow, the high-margin Nectar 360 data monetization wildcard, and its sheer grocery scale make it a formidable value play. It might fail the aggressive growth tests, but it passes the defensive capital allocation tests with flying colors.
So I'll leave you with this final thought to ponder. Take a step back and look at the data we've just unpacked. Weigh that massive free cash flow and those shareholder returns against the natural growth constraints of the UK grocery market. Ask yourself, is this £33 billion giant a hidden deep value cash machine utilizing tech like Nectar 360 to build a new moat? Or is it simply a slow-growing value trap destined to trade sideways? The data speaks for itself. The final analysis is up to you. Thanks for joining me on this explainer, and keep looking at the numbers.